Hello everyone, my name is Abhishek Kumar Gupta and I am going to present my project report on portfolio optimization using descriptive statistical analysis and diversification. So the objective of my presentation would be, first of all, I'll introduce the Markowitz portfolio theory and give a brief description about the minimization of the risk of the portfolio. Further, I'll explain the diversification and how does it work. Then I'll discuss about the statistical analysis of stock prices, where I'll introduce the different stocks which has been analyzed. Then I'll talk about the portfolio optimization using different stocks, where the portfolio would comprises of different combination of two stocks out of six. Then the portfolio will be made using three stocks of out of six stocks, and then different combination of four stocks out of six, and then finally all these six stocks will be used to make an optimal portfolio. And finally I'll conclude with my summary and conclusions. So let us first discuss the introduction to the Markowitz portfolio theory. As we all know, Harry Markowitz proposed the theory in 1927, and which is popularly known as the mean variance portfolio optimization theory. So what happens that when usually a risk averse investor aim at minimizing the risk and maximizing the return, where the return is given as the ratio of xt by x0, where xt is the amount of money received after selling the asset and x0 is the amount of money invested in the asset, and the rate of return is defined as the xt minus x0 by x0. So this is what is defined as the return and rate of return. So coming to the minimizing of the risk of the portfolio. So in order to minimize the risk, we have to minimize the formulation which is given as the variance of portfolio as xa squared multiplied by variance of returns of A plus xb squared multiplied by variance of returns of B plus 2 times xa, xb and covariance of Ra and Rb. And the overall constraint would be the total budget should be equal to 1, where xa and xb are the amount of investment allocated to proportion of the investment allocated to xa and xb. Solving the above formulation with the constant, we can determine the value of xa and xb, where xa will be given as the variance of Rb minus covariance of returns of A and returns of B divided by variance of returns of A plus variance of return of B minus covariance of return of A and return on B. The xb can be defined as the variance of return on A minus covariance of return of A and return of B divided by variance of return of A plus variance of return of B minus covariance of returns of A and return of B. Coming to the diversification and how does it work. So let us consider the portfolio with n securities. Then the variance of the return for the portfolio will be given as sigma p square is equal to sum of I equal to 1 to n xi square sigma I square plus sigma I equal to 1 to n sigma j is not equal to I to n multiplied by xi, xj and sigma ij. So if all the allocation to the securities are equal, we get 1 by n allocation of total wealth to each security, and the above expression will become sigma p squared equal to summation I equal to 1 to n 1 by n square sigma I square plus summation I equal to 1 to n and summation j is not equal to I to n 1 by n multiplied by 1 by n and sigma ij. So from the above equation we can clearly see that the variance is inversely proportional to n. Hence, with increase in the n or the distribution of asset in multiple distribution of on total fund in multiple assets decreases the variance and risk. So further, the statistical analysis of stock prices has been done in this project. So for this project, I have taken the closing stock price of 6 different stocks, including IBM, ExxonMobil, PA, Microsoft, Goldman Sachs, and Walmart. The period of the data was for the 8 years, including July 2010 to from till July 2018. So in all those data, the different mean returns for each of the stock prices has been calculated, and the variance and covariance matrix has been generated using the formula which has been described before. So further, the descriptive statistical analysis of all these 6 stocks has been done using the histogram plot, box, and whisker plot. So let us consider the example of IBM, where we see the left plot indicates the variation in the stock price with date, and we can see there is a very high fluctuation in the stock price going from 100 to maximum of 180 over the period of 8 years. So this variation is very well captured in terms of these statistical plots of bar graph, histogram, and box whisker plot. In the central histogram plot, we can see the return has been varying from minus 0.06 to 0.08, where most of the returns are varying in this range with very low to extremes value. And also the box and whisker plot indicates the central tendency of this return of this stock is around 0, and the first and third quartile are given as minus 0.0275 and 0.05, and with some outliers. So let us first discuss the portfolio optimization using the 2 stocks. So in this case, what I have done is I have generated a portfolio using taking different combination of 2 stocks out of these 6 stocks, and the mean return is calculated by the formula RT equal to PT minus 1 divided by PT minus 1, where RT is the return at time t, PT minus 1 is the closing stock price at time t minus 1, and PT is the closing stock price at time t. Also, the covariance matrix has been generated for all these 6 stocks using the formula which has been described before, and using these covariance and the return formula, we determine the optimal portfolio of the combination for the 2 stocks IBM and ExxonMobil, and the results are described in the below table, where we see that for the optimal portfolio should contain the 44.02% fund allocation to IBM stock, and the rest 55.98% of the fund allocation should be to ExxonMobil, and this will give the optimal return of 0.6% and the minimum standard deviation of 3.93%. However, not all the investors are risk averse. There are some investors who would like to go for higher risk in view of higher returns. Basically, they have different risk tolerance. So the different combination of allocation of total funds in the 2 stocks can be used to generate different expected returns and standard deviation. The left table indicates the different combinations of ExxonMobil and IBM stocks, and we can see the expected returns and the standard deviation. The plot in the right gives the plot of for these 2 stock values, where x-axis indicates the risk or the standard deviation, and y-axis return gives the expected return value. From this plot, we can see that there is a expected return value for each different risk, and the orange plot indicates the most optimal values for the minimum risk and a higher return value. These orange points indicate the efficient frontier for the 2 stocks considered. So different combination of the 2 stocks out of 6 has been analyzed, and the results are in the left table, and the bar graph plot in the right shows the returns and the standard deviation of each different cases. Here we can see that the standard deviation is fluctuating a lot, varying from minimum of 3.83 to maximum of 5.51. So the lowest standard deviation of portfolio we can see is around 3.83 for the two stock portfolio case. Let us consider the portfolio with three stocks has been used. So this is the result obtained by solving the data using solver, and different combination, the three different combination of the stocks, taking three stock each time from the six stocks has been analyzed. So again the blue bar represents the portfolio return and the orange bar is indicative of the portfolio standard deviation. Here we see that the lowest standard deviation can be observed around 3.39%, and which is little bit lower than the 3.83 which has been observed in the case of two stocks in a portfolio. So this is the basic fundamental behind the principle of diversification, where we see that lower risk is obtained with increasing the number of stocks in a portfolio. So let us consider the case for the four stocks. Again, the four stock combination out of six has been chosen and analyzed for using solver to obtain the optimal portfolio return and portfolio standard deviation. Again, here we see that in case of ExxonMobil, BA, Microsoft and Walmart, the minimum standard deviation, which is 3.29, has been observed. Again, this can be compared with the previous minimum standard deviation, and this is pretty much lower compared to the case with two stocks and three stocks in a portfolio. And similarly for five stocks, we see that for case of for the third case, where the blue bar is indicating again the portfolio return and the orange bar indicating the portfolio standard deviation, we obtain a significantly lower standard deviation, which is around 3.24% compared to the previous case of four stocks in a portfolio, which gave the minimum standard deviation for the combination around 3.29%. Finally, all these stocks has been used to make a portfolio. So here we see that the percentage allocation of IBM, ExxonMobil, Boeing company, Microsoft, Goldman Sachs and Walmart. So the different percentage allocation has been allocated to each of the stocks, and we obtain a more optimal portfolio with these six stocks, giving the portfolio return of 1.01% and the minimum standard deviation with 3.2%. So in this case, where all these six stocks has been used for making the portfolio, we obtain the lowest standard deviation of all the cases. So in summary, we can see from the table that with increase in number of stocks, the total portfolio standard deviation is decreasing, and from this picture is pretty much clear from this bar graph, where we see the continuous decline in the total standard deviation of the portfolio or the risk of the portfolio with increase in the number of stocks. So which can be clearly seen from the case from two stocks, which gives a standard deviation of 3.83%, which compared to the 3.2% of standard deviation obtained when all these six stocks has been utilized to make the portfolio. So from this plot, it can be clearly said that with diversification of the fund in different assets or multiple stocks, we can eventually minimize the risk, and this is the basic fundamental behind the concept of diversification in the portfolio management theory. Thank you.